In one of my earlier YouTube videos, I had explained how investors should evaluate high growth stocks trading at extremely steep earnings multiple. Evaluating Dixon Technologies showed us what even the slightest slowdown in growth could do to valuations. Dixon's 200 times price to earnings multiple meant that if you were to hypothetically buy 100% of the company's shares, it would take 200 years for you to earn back your initial investment through the company's ongoing profits. But Dixon is not the only stock that has soaked in excess liquidity floating around in Indian stock markets in recent months. And it is not the only stock showing signs of bubble. Liquidity inflow not just from foreign institutional investors or FIIs, but also domestic investors by way of systematic investment plans or SIPs has been consistent. And unlike the rest of the world, India's central bank RBI is not to be blamed for the excesses. Just a decade back, the loose monetary policy and credit policies of 2006 created a bubble in the Chinese stock market. At that time, Chinese regulatory authorities imposed policies that sought to reduce the risk of a stock market crash. For example, the People's Bank of China raised the renminbi deposit reserve rate 10 times from the beginning of 2007. But the rising deposit reserve rate did not decrease excessive liquidity in the stock market. A large volume of hot money continued to flow into the Shanghai A-share stock market index, which is the blue chip index, driving the stock prices continuously up. At the end of 2007, global financial turbulence caused major international stock markets to fall sharply. From November 2007 to January 2009, the Shanghai Blue Chip Index or the A-share index fell about 9.2%. This set an international milestone as the largest ever share price decline in history. In comparison, India's stock market is today largely reliant on domestic inflows. But will such liquidity stay resilient in the wake of a global tremor? Well, that remains to be seen. Now, taking some profits off the table to prepare for a market correction is never a bad idea. Rather, at Equitymaster, we always recommend readers and subscribers to ensure that they have funds to buy more stocks when valuations correct. That is precisely why I have been recommending my subscribers to sell partial exposures to stocks that have met target prices or are in extreme valuation territory. But the question remains, what should you not sell even at market peaks? To answer this, I always go back to one of my favorite memos of Howard Marks, Selling Out. In the memo, he wrote, when you find an investment with the potential to compound over a long period, one of the hardest things is to be patient and maintain your position as long as doing so is warranted based on the prospective return and risk. Investors can easily be moved to sell by news, emotion, the fact that they have made a lot of money to date, or the excitement of a new, seemingly more promising idea. When you look at the chart for something that's gone up and to the right for 20 years, think about all the times a holder would have had to convince himself not to sell. Howard Marks gives us the example of investors regretting by not having bought Amazon when it listed at $5 in 1998. But then he asks, how many would have continued to hold on when the stock hit $85 in 1999, up 17 times in less than 2 years? Who amongst those who held on would have been able to avoid panicking in 2001 as the price fell 93% to $6? And who wouldn't have sold by late 2015 when it hit $600, up 100x from the 2001 low? Yet, anyone who sold at $600 captured only the first 18% of the overall rise from that low. In short, a good deal of selling takes place because people like the fact that their assets show gains and they are afraid the profits will go away. Selling out of a position is much harder to do well than buying into it. People hate losses a lot more than they enjoy equivalent gains, but reserve a special loathing for crystallizing a certain loss. Most people invest a lot of time and effort trying to avoid unpleasant feelings like regret and embarrassment. What could cause an investor more self-recrimination than watching a big gain evaporate? If you sell an appreciated asset that puts the gain in the books and it can never be reversed, then that's the best thing to do. Thus, some people consider selling winners extremely desirable and they love the realized gains. You might wonder, are the fund managers and institutional investors better at selling? Unlike retail traders or investors, the pros typically do not cling on to losers. Yet they do not make selling decisions the way they make buying ones. That is, by choosing the asset, adding the least to their risk adjusted return, and offloading it. Instead, they just select positions where relative performance had been very bad or very good and exit those. As a result, they too often throw away two-thirds of the excess returns their skillful buying had won them. Fund managers also face constraints that prevent them from selling perfectly. At times, they may be compelled to sell as the capital could be needed for another purchase or to return to investors. Moreover, if the stock to be sold is relatively illiquid, the fund manager may need to plan weeks ahead to offload the stock in order to find buyers at lower volumes. So, it is not that the professional fund managers have the selling decisions very easy. On that note, here's a simple checklist that I run through to decide when not to recommend selling and select the stock not to sell. According to me, there can be only three reasons for selling a stock even at market highs. The first, stocks that you want to own like you own the business. If you own a stake in a private sector company with enormous wealth creating potential and compounding potential, strong balance sheet, and great management, you should never want to sell it fearing near term correction. Great compounders are extremely hard to find, so it's usually a mistake to let them go. Also, I think it's much more straightforward to predict a long term outcome for a company than a short term price movement. So, it doesn't make sense to trade off a decision in an area of high conviction for one in which you're limited to a low conviction. Second, if the current valuation of the stock cannot undo the discounted buy price and the long holding tenure. Now, no matter what the valuations of the stock today are, if you have bought the stock when it traded at deep discount and held on to it for long years, you've already hedged your risk. Therefore, current valuations should not be the only reason to do away with such stocks. Third, if the stock is a high cash flow investment. What do I mean by that? Businesses that are financially sound and regularly pay off their healthy cash flow to shareholders by way of dividends and buybacks may be great investments to hold on to. Notwithstanding the chance of temporary correction, the dividend receipts from such stocks may over time more than compensate for the long holding tenure. Cases in point are stocks like Asian Paints and HCL Tech. Meanwhile, if you wish to know the list of stocks you should consider selling for fundamental reasons, do check out the Equitymaster screener. Hope you like this video. Thanks for watching.